Okay, ladies and gentlemen, welcome to Two Truths and a Lie, OurCrowd's fund manager panel. There is a thinly veiled attempt to jazz up a session with four white middle-aged fund managers and make it just a little bit more racy. And why is it racy? Because Two Truths and a Lie is a drinking game. And the way the game works is as follows. The participants are going to share with you three statements, two of which are true and one of which is a lie. And it is our job to figure out which one is their lie. And if you get it right, there's some sort of drinking involved. So if you look under your chairs, there's a gift from OurCrowd to make this a little bit... Okay, that was the lie. But for those of you who looked and you're ready to drink already this morning, I appreciate that. So what I'm going to do is I'm going to introduce our panel to you first, and then we're going to dive into their statements and your responses, and we'll explain how that works in a second, and then that will form the basis of a panel discussion. So starting at the far end, Jacques BENKOSKI is a partner with US Venture Partners. USVP, for those who don't know it, is a storied Silicon Valley fund. They're out raising their 12th fund right now. Jacques has been with them for many years. Before that, led several large technology companies, of which USVP was an investor in a couple, you know, has 2 degrees in computer science and engineering, and it's a pleasure to have us with you today. Johnny Sachs is managing partner of F2 Capital. F2 is a Tel Aviv-based fund that invests in the frontier of AI, big data, and connectivity. Before his time at F2, Johnny was at Genesis Partners and also at Gemini, which was really one of the pioneers of the Israel VC landscape. And while there, Johnny started The Junction, which is the first ever accelerator in Israel. MICAH TAPMAN joins us from Boulder, Colorado. MICAH runs 730 Opportunity Fund, an early-stage cannabis tech investment fund. And before he started the fund, MICAH ran Canopy Boulder, which is the largest cannabis tech accelerator in the world, investing in almost 100 cannabis-related companies. Clearly an exciting space today. And if you guys have follow-up for MICAH or any of these panelists afterwards, feel free to hunt them down. John Backus, on my right, is the general partner of PROOF. PROOF stands for the Pro Rata Opportunity Fund. It is a US-based fund that has a very innovative structure that monetizes the unfilled pro rata rights of micro VCs in some of their hottest companies. Now, for those of you who don't exactly understand what that means, that's fine. John will be happy to explain it to you. But they've built up a portfolio of some of the most incredible names in venture capital through this structure. John has had a storied career in venture capital. Before that, spent 15 years at New Atlantic Ventures, served on the board of the National Association of Venture Capital, has a background in consulting from Bain, and has degrees in a BA and an MBA from Stanford University. So it's a wonderful panel that we have here, and unbeknownst to the panel, I've actually split them into teams just to make this even more irreverent. So we have Team USA here, MICAH and John, and we have Rest of World over here with Johnny and Jacques. Now, it's a little bit strange because Jacques works at USVP in Silicon Valley, so he's on the Rest of World team, but I guess his partners back in Silicon Valley will be happy whatever happens. If you lose, America wins, and if you win, USVP looks good.
I thought it was a jacket color.
So with that, let's get started on the game itself. So, guys, if you wouldn't mind setting up the Slido. Okay, fantastic. So what you're going to do is if you can take out your cell phones and go to slido.com, you will see an option to put in a game code. Type in hashtag, I mean, the hashtag might be there already, type in G300. I'll give you guys just a second. Can you guys see? It comes up big. Okay, great. Hands up anyone who still hasn't had a chance to do it and wants to. Okay, great, just another second. Fantastic. Okay, let's get ourselves started. So first up, I believe, is John Backus. So John, if you would, read out each of your statements that haven't come up on the screen here. So maybe you'll have to turn around, unfortunately, but read those out to the crowd, and the crowd will then have a chance to vote on which one they believe in.
This is like an acrobatic test or something.
So don't forget your mic.
Number one, 75% of all venture capital deployed around the world over the last 20 years. What's that? Oh, did it move?
Well, oh.
People voted already, okay? I got it. Okay, so the questions are, number one is, VC returns have beaten the Dow Jones for the last 20 years by about 10 points per year. Truth or lie? Number two, 75% of all venture capital deployed around the world is invested in US-based companies. Number three, in the US alone, there are 20,000 venture-backed startups with a market value of over $1 trillion. One of those is not true.
What is the voting? They vote what is the lie?
They vote for the lie. You pick the lie. Okay. Looks pretty clear like we have oh. All right, we're going to conclude the voting in 3, 2, 1. Okay.
Okay. 15 years ago, 90% of all venture capital deployed around the world was deployed in the United States. Last year it was 52%. That's not because it's dropped in the US. It's actually increased pretty dramatically. It's because the rest of the world has risen dramatically.
Okay, so everybody on this side of the room drinks. No, but really, okay, so John wins. It's 1,000 points to Team USA. Up next is Jacques.
Okay, so number one is venture is a complex business and takes a decade and $40 million to become a good VC. The second one is VC can help entrepreneurs tremendously, but VCs need to understand their limits. And the last one, VC added value services can turn a bad company into a successful one.
Okay, looks like we've got pretty close to, well, okay, another 3 seconds to put your votes in. 1, wow, 2, 3, okay. Okay. So we've revealed the right answer. Jacques, you want to read it out?
So VC added value services can turn a bad company into a successful one. The answer is that's a lie. If it's a bad company, no amount of help is gonna help be successful. And actually, beyond that, we believe that by helping a company too much, you can turn what might have been a successful company into a bad one. So we can expand on that later.
Very good. Okay, so that's 500 points to the rest of the world. Micah TAPMAN, it's back with you.
All right, I'll try to read these. Okay. Number one, VCs do not sign NDAs.
What's an NDA?
Non-disclosure agreement.
Okay.
Number two, VCs know the right value for your company. And number three, VCs are helpful finding key talent for your team.
Okay, get the votes in. Wow, real skepticism about VC here. Okay, that feels pretty conclusive. VCs know the right value for the company. Nobody seems to think that's the case.
Yeah, well, that was a good call, actually. Yeah, they were correct. The audience got it.
Okay, so no points for Team USA there. So it's interesting now. Johnny Sachs with the last set of questions. This is a good one.
Okay, so number one is that Series A investors will pay between 2 to 3 times more for good companies than the seed investors paid. The second one is that the best performing funds aim for a home run, which is, let's say, more than 10x, 20x every time they invest. And the third one is that serial entrepreneurs are more successful than first-time entrepreneurs.
Wow. Okay. Gonna give it another 3 seconds. Get your votes in. 1, 2, 3. Johnny, no one reveal the results. Johnny, what's the right answer? Or what's the lie?
The lie is the last one, so that serial entrepreneurs are more successful than first-timers. I'm happy that my teammate here has some real statistics to back it up, based on 500 companies that they backed or they've looked at. But my simple answer, or a few simple answers to that, is if you look at the big 5 technology companies, Facebook, Apple, Google, Microsoft, Amazon, were all started by first-time entrepreneurs. Coincidence? I don't think so. So first-timers, only see blue skies. They are less concerned with the risks and the obstacles if they believe in their business, and they're aiming high and they want to disrupt the world and disrupt the industries, whereas serial entrepreneurs and more experienced entrepreneurs have a bit of caution there. They understand the risks more, they know that there are risks, there are obstacles, and they're a bit more hesitant, and therefore in our business of VC, when you are looking to make home runs, every investment, first-timers, in my opinion, the more successful ones.
Amazing. Well, that was the winning question in terms of beating out the audience, and that is a big victory for the rest of the world. So, congratulations, Jacques and Johnny. The prize will be awarded afterwards. It's incredible. Okay, so now let's move on to the panel part of the conversation. So, Jacques, you started off with a statement that it costs $40 million in a decade to train a VC investor. That sounds like a heck of a lot of money and time. Can you maybe give us a little insight into what that really means and why you think it's so expensive and so difficult to understand how to go invest in a startup?
Yeah, actually, I didn't invent that statistics. It's a well-known statistics. I'm not sure who quoted it the first time, but it's a known statistics. Why is VC such a hard business? Because it's probably the most multifaceted business I've ever seen. You have to run the firm. That's one business. You got to build a portfolio, which is a very complex thing to do. You have the right mix of companies. You have to make the right investments. You have to work on your investments, make them successful, do all the stuff that we actually spend most of our time doing. And then you have to manage, the exits and the distribution. You have to all that in a normal week. Your mind is constantly moving between those different elements. And without the coaching and the experience that you get, in my case, I was lucky. I joined a very large firm that had experience. But if you learn by yourself, then typically people will make a lot of mistakes. And that's where the statistics come from. And
therefore, and John, if I can ask you, do you think that it matters for a VC whether you've come from the company side? I mean, both you and Jacques, and in fact, I think all of you on the panel have had plenty of company experience before you went and became VC investors. How important is that to the training?
Well, I think it's hard to put yourself in the shoes of an entrepreneur if you haven't been an entrepreneur, or if you haven't started a company or been with a company. If your entire background is having spent time on Wall Street, when you're sitting in a boardroom and the company's struggling with cash flow, you really don't have a clue, as to how to guide that company on what to do. What I would say, sort of expanding on the point here, is, we talk a lot now about artificial intelligence and machine learning. That's all about pattern recognition. What venture capital is about pattern recognition. And the training a VC has to go through is about pattern recognition. It's like, if you think about it, you might get 5, 10, 15, inbound things a day to look at. You have to figure out which one of these am I going to spend any time on, and dismiss the ones quickly. You're not going to spend time on them. When you meet with someone, you meet with a lot of people, you're going to want to decide which one do I want to move on, which one do I want to invest in, and then when you're in the boardroom, you got to sort of know when to talk and when to shut up. And all of those things are really what I call pattern recognition things that takes time to develop.
I just want to put it to Johnny for 1 second, because Johnny spends probably more time on AI than anybody else. And if it's true that VC is just pattern recognition, does that mean that in 10 years' time, it's going to be 4 robots and me on the stage?
5 robots. 1 robot.
There's no pattern recognition here.
I think one of the multifacets that Jack was talking about is that it's an unknown combination of art and science. VC, definitely, and the earlier stage you get, there's more art, in my opinion, than science, and the later stage is, then AI or machine learning or pattern recognition can actually be applied successfully. but it's definitely a unique combination of art and science, and I don't think that'll change through AI or...
So you guys will be back here next year?
I hope so.
And let me just jump in there on 2 points. One about whether running a company is helpful to a VC. I think one of the biggest differences between VCs and other types of finance professionals is we're dealing with companies where it's more important to understand the businesses and the workings of the business than the financial engineering of the firm. And that's very, very different than private equity companies, which typically are coming in with a financial engineering approach to a business that already has an existing working structure, and all they're trying to do is leverage the company better or somehow change the financial engineering. I think that's a very, very different thing about VC professionals. I think the other thing about the learning curve and why does it take so much time and so much money to learn, it's because your mistakes don't become evident for a long period of time. So as a VC, if you make a mistake in a term sheet and you write up a bad contract, essentially, you miss one little thing, it might be 6, 7, 8 years before that comes back to bite you and you realize that you actually made that mistake.
That's a great point. So let's think about it from the fund's perspective now. So you've had all this training and you have all this experience, and yet, Johnny, you asserted that every time you make an investment, you're swinging for the fences to try and hit a home run. If you're a brilliantly smart, thoughtful investor, can't you figure out that sometimes a 2x, a 3x return, a quick trade is a good use of capital? Is it really true that every time you invest, you have to go and hit a home run?
Definitely. I think that's very true, that you have to go for those home runs, for those, let's call it, billion-dollar companies. Every time you make an investment, at least believe that they have the potential to do that, because you have a limited amount of capital to build the portfolio. And one of the things that, again, Jacques was talking about is not only building the portfolio, it's then managing the portfolio. And then which of the companies do you continue investing in, follow on investing in, to maintain your holdings in that company? Because unfortunately, at least from my experience, I'm sure these guys are different, but from my experience, not all the companies will be successful. And therefore, the companies that are successful have to make the returns and, be the performers of the fund. So if you come into a company initially thinking that this company can only do 2 to 3x, even if you think it's a high probability, you've wasted kind of your silver bullet or one of your silver bullets to make the returns. Simple math, $100 million fund, we need to return 300. We want to return 300 million, So if a company that you invested 5 million in returns 10 or 15 million, that doesn't make really an impact on the 300 that you have to return. So every company that...
But what if every company returned 2 or 3x? So you put 5 million out.
Yeah, if every company returned 2 to 3x, that would do it, because you want to return 3x. Or if one company returned 3x, then that would do it as well, right? But as we said, you build a portfolio, and unfortunately, not all companies are successful. We know the statistics. In fact, more companies are not successful than successful. And what we want to happen, what we want to happen is that every successful company is a real success, right? So that it returns that 3x.
Got it.
Fund.
So you've had all this training, you understand how you need to invest, and yet apparently everybody in the audience knows that VC has no idea how to think about value. So what's the disconnect there, Jacques?
I don't know that I necessarily buy that. It's an art more than a science, but there is sort of an equation that everybody runs through, which is what is the value of this company at the end game? It will have $200 million in revenue. It will, on a comparable, be 8x revenue. Therefore, it's a $1.6 billion company. How much money does it need to get there? And you do the math backwards and you say, the most I can pay to get my 10x return is X. And you don't know exactly whether it's worth that or not, and it's partly market dynamics, competition. It's partly your reputation, the reputation of the entrepreneur. But at the end, there's a price that you can't pay more than. Otherwise, instead of having an option at 10x, you don't have that option anymore. And if you don't have that option at 10x, then you're not going to have a 3x fund. And you have to stay disciplined. And if the valuation gets out of hand, you walk.
You're seeing a lot of high-value companies right now.
Yeah, let me, why don't I tell a truth that no VC will tell you when they're out pitching their fund. That is that we're not rocket scientists, and we fail more than we succeed. You know, people think that we have this gift for finding great companies. If you look at the research from Harvard Business School, from Josh Lerner and Bill Solomon, it's the 80-20 rule. You know, in a VC portfolio, 80% of the return is driven by 20% of the companies. What does that mean? If you have 25 companies in the portfolio, 5 drive all of that return. When we invest in those 25, we think they're all going to be home runs or have the potential to be home runs. So we're failing, you know, or coming in well under our target 80% of the time. You know, there are 2 ways to build, in my opinion, a successful portfolio. You swing for the fences and the math works for you because your upside is unlimited on any great company. Your downside is limited to the cash that you put in. And if you can get a 10 or 15x on 3 to 5 companies, if you lose money on everything else, your fund's going to do well. Now that works great early stage. The later stage you go, the formula changes. You know, if you have a $500 million fund or a $1 billion fund, you're not looking for, you know, 3 or 4 companies to deliver all the returns. You know, our fund strategy is very different. We're looking for a 3 to 5x on every investment, but we're coming into companies that are already mature, that already are growing at 2 to 3x a year. So if you have a lower loss rate, you don't have to have the 10 to 20x's if your loss rate's lower. So it's math. You know, there are different ways to build portfolios.
Great. So I think what we've assessed from all of this is that maybe VCs are smart, maybe there are reasons why they don't know value day one, and you've restored faith that if you've had the training and spent all that money, there are some intelligent people on the stage who won't be replaced by robots. But then when you flip it the other way around and you look at it from the founder side, all of a sudden Johnny's telling us that forget all the experience, forget all the training, let's take someone who doesn't know anything, and he's our ideal candidate to go hit the home run with. So how does that happen that it's totally the inverse from the founder perspective? Yeah, please.
I think you took it a little bit to the extreme. We're not looking for someone who doesn't know anything, or we're still looking for people.
I know some of your portfolio CEOs, Johnny. No, I'm kidding.
I think I have to leave.
Yeah.
So, you know, we're looking for people, founders that are, you know, extremely driven and passionate about what they do and believe sincerely and, you know, in their business and how they're going to change the world and disrupt the world, et cetera, and all those lovely words. They still need to build a team around them with co-founders, et cetera. They need to definitely understand in the technology and how this technology can be implemented. So there's a lot of things that they need to do. But with regards to the type, in my opinion, the type of entrepreneur that can, you know, is more likely to succeed in building those home runs and those 20x companies are the first timers because of the reasons I mentioned.
And MICAH, you see a lot of very early founders coming through an accelerator program, and then in an industry that's moving very quickly where you're seeing some real success right now. How is that pattern shaping out for you with experience versus sort of freshness in the market?
Yeah, I think it's interesting, and I've thought a lot about this actually with regards to hard science. And physics is a good example where the adage is basically nobody invents anything in physics or discovers anything in physics after they turn 30. So they've got to be, you know, a young buck in the field. And I think a lot of that is sort of similar with entrepreneurial work. It doesn't really actually matter what chronological age you are when you're starting a company, but you need some combination of a bit of experience and education and background with a bit of craziness and a bit of vision. And there was a discussion yesterday at the VIP forum talking about storytelling and how what's really neat about entrepreneurs is that they're able to tell a story that changes your perspective of the world. And this is really important for me as a VC, as I'm listening to an entrepreneur tell their story. Are they changing the perspective? Are they changing the paradigm of the world? If they are, and it still feels somewhat reasonable, right? This isn't, you know, beam me up Spock or Scotty, you know, to the Star Trek Enterprise here, but rather, okay, this is sort of a big leap, but not a crazy leap. That's when I get really intrigued, and I go, okay, this person might have something going for them that combines that craziness with the reality of trying to actually run a business and make a business work over the next, you know, 5 to 10 years.
Jack?
Yeah, there's a flip side to, you know, the first time versus second time entrepreneur. The point Johnny made is absolutely correct. There's another one, which is second time entrepreneurs are going to make mistakes that a first time entrepreneur isn't going to make. They have a huge advantage in that they can attract capital and they can attract talent much more easily.
Sorry, second-time entrepreneurs are going to make mistakes that first-time entrepreneurs won't make.
That's right. And the classical mistake they're going to do is they're going to try and apply the formula that made them successful in the first time, the second time. But it's a completely different situation. They're probably going after a different problem, different time in the industry. What worked doesn't necessarily work again. And they are much slower to recognize their mistakes because, hey, they were successful before. And so if you look at our portfolio, we are very aware, you know, of 500 companies that, yeah, it's not a magic wand that you can say, hey, partner with so-and-so who's built this company XYZ, and they'll repeat. We have cases like that, you know, we've backed Shlomo Kramer every time around, but he's a one-off. There's many people that we back the second and third time, and we're very disappointed. So there's a little bit of that craziness, but there's also the humility of knowing what you don't know and being willing to learn all the time, which people tend to lose if they've been successful.
Well, I think another point to that as well is that there's this idea that somebody knows the answer to how to build this company. And that's a really interesting trap, I think, that entrepreneurs and VCs fall into, that there's a solution out there, that there's some answer and we're just discovering it. We're just, you know, going to go figure out what it is. And next thing you know, you've got yourself an Amazon or a Microsoft or an Oracle or whatever it is. And I don't really believe that's true because the dynamics are changing literally minute by minute, hour by hour for every one of these companies, whether it's the people involved or the market around them or the financial conditions of the world. And so getting stuck in any rut and any belief that, oh, there's this solution out there, there's so much luck involved in what we're doing that I think you've got to be very flexible and agile as you're building these businesses, whether you're sitting on the VC side or you're sitting on the entrepreneurial side.
Okay, do you want to add that, please?
I'll add one thing to it, which is I think the panel's touched on it a bit. I think it's less about being a first-time entrepreneur than about being a young entrepreneur. And, you know, we're all older guys up here, so I don't want to sound ageist, but, you know, if you look at the FANGs, you know, the Facebooks, the Amazons, the Netflix, the Googles, you know, those companies were not just started by first-time entrepreneurs, they were started by teenagers for 3 of them, and by people in their 20s for the rest of them. The point you made about, you know, physics discoveries being made by young people, you know, a friend of mine actually from Benchmark did an analysis on Nobel Prize winners. You know, people who win the Nobel Prize are generally in their 60s, 70s, or 80s, but the moment of their discovery happened in their 30s. And unfortunately, most research, at least in the United States, for example, that comes out of the National Institute of Health, goes to people who are researching in their 40s and 50s because they have great pedigrees. So, you know, there is some advantage to youth, whether it's inspiration, whether it's the ability to look outside the blinders that you might otherwise see, you know, there's an advantage there.
Yeah, I actually don't agree with that.
Here we go.
I think you have to have a certain intimacy with the problem you're trying to solve. And there's very few problems that you have such a clean table that you can know everything about that problem at a very young age. You need to have worked in the industry in which you're going to enter and have some knowledge around that to be successful. I think you have to have judgment. Now, of course, your statistics is correct, but you know, SanDisk was done by Eli Harari. He was in his 50s, right? You can find lots of examples of very successful companies that were started by people much later. So I think there's a bit of ageism going on, or youngism if you want it the other way, which is, oh, look at this young, bright person. And I don't think it works that well, and I think also people don't fully value the psychological difficulty of being a CEO. And when you're very young, you're much more fragile, and you know that's why the rate of depression and things like that among CEOs is very high, which we know is an issue, because you take those people, you put them on a pedestal, and you hope they're going to make it when they don't have the resilience that it takes to be in that position. So we could debate that.
One of the beauties of this business is that there's no formula to success, right? Everyone has different opinions. The analogy that I always use as an Israeli to an Israeli crowd in this case is that, you know, there's a reason that we joined the army, the military at 18 and not when we're 40, right?
So you have young founders, you have older founders, there's obviously a lot of first time out there who are doing amazing things. the question is, where does the VC come in to be helpful? And Jacques touched on it when he said that you can't turn a bad company into a good one by just giving them value-add services. And I think Michael also touched on kind of the helpfulness of VC value-add and where it is and isn't relevant. So away from picking winners and financial engineering that happens on the VC side, talk a little bit about where the value add from the VC in terms of helping the company in its growth is truly meaningful, and where VCs fall short and can't take it all the way. Micah, you want to start?
Sure. So this is sort of near and dear to my heart because I run a focused fund, right? So we invest in technology and the ecosystem around the cannabis industry. And so the value that I am going to bring to the table is primarily knowledge of the industry. Right? I know most of the major players. I understand the dynamics of the industry, often honestly better than the entrepreneurs who are jumping into it and getting involved. And so what I'm bringing to that table is depth of knowledge, depth of contacts. The Rolodex, well, I guess Rolodex is a bit of a dated term now, but the contacts list on my phone is pretty impressive. So being able to reach out, text message with people, all of those things and open those doors, I think is incredibly valuable, particularly where I focus, right? As a small VC focused in a niche area, you know, cannabis tech, that's really what I'm bringing to the table. And oftentimes it's a question that I'll get from an entrepreneur, things like, can you make an introduction to so-and-so strategic partner? Yes or no. Can you help me find a CTO? Because the current CTO I have is now at the end of his or her life cycle and can't bring the company to the next stage of development. Those are all sort of key areas that I'm able to help with. And of course on the finance side, you know, that's a big piece as well. Again, sort of leveraging up to the next level VCs, whether it's like US venture partners or something like that who might come in at a later stage to a company that I'm in.
You want to use it? Jack? Or John?
Just a couple of words. First of all, I think that the most important Hippocratic oath should be to VCs, and that's do no harm. So
say that again, because I think your mic, all of our mics.
I said the first thing VCs should remember is the Hippocratic oath, which is do no harm. That's the most value they can add, because the CEO, the founding team, the management team are the ones that should drive the business and lead the business. And so the first thing is most important, do no harm as a VC. VCs can add value a lot, but they can also cause some damage, so you need to be aware of that. And I think it's important for the entrepreneurs to really know who they're partnering with as an investor, as a VC, someone that can add value and has experience and a track record of adding value and the right value to companies.
John, can you talk a little bit about where the harm that Johnny talked about in where a VC can actually cause problems for a company? What does that look like?
Yeah, I think the thing as a VC we have to be most cautious about is what Johnny mentioned, which is, you know, it's not our business. You know, we have influence, but we're not the CEO. You know, if I want to go be the CEO, and I've been a CEO before, I should go start a company. You know, but our job as a board member, you know, is to influence. Our job is not to tell the CEO, this is what your strategy should be. And if we don't agree with their strategy, we have the option to vote against a budget, to not put more money into the company, to, you know, talk to the CEO and other board members about, you know, replacing them. But, you know, our job is not to tell them how to run the business. You know, I will expand on one of Johnny's points, which is when you look at picking a venture capital firm, look at picking the person that's going to be on your board. It's not just the name of the firm, it's the person you're going to work with, because, you know, these days, especially if you're starting a company early and you're getting in with an early stage VC, that VC may be on your board for 7, 8, 9 years. That's longer than the average marriage in America. So, you know, just keep that in perspective, that you're going to be with this person for a long time.
Jack?
And you cannot divorce them. No, I think those were very good points. I can't repeat them, but I would otherwise. I think I want to address one element which was behind that question, is the notion of value-added services. A lot of firms have started hiring, you know, talent people. They started hiring marketing people, and all that with the notion of helping companies, especially in the early days. And the red line is between helping and substituting. You cannot substitute the company building the skill set early on to hire. You can't substitute the skill set of knowing how to market themselves. You can't substitute the skill set of finding their first customers. And especially over the last decade, there's been sort of resurgence of that as a fashionable thing to do. And a lot of entrepreneurs get seduced by that because they think it's going to make their life easier. It doesn't. And the reason is very simple, because growing a company is, by necessity, a Darwinian process. Only the agile should survive, only the best should survive. And if you're not facing the tests of hiring, the test of marketing yourself, the test of finding your customers by yourself, or mostly by yourself, you're not building that skill. And if you don't know how to do that at a small scale, what's going to happen when you're going to have to do it at a large scale? Imagine a company, I have the chance to be on the board of a company that went from 500 employees to 1,000 employees last year. If they hadn't hired the first 20 themselves, they had to rely on somebody else to do it, they would forever have a foundation that wouldn't be solid enough. And when they have to grow from 500 to 1,000, they'd be terrified. They were terrified anyway, but they would be double terrified. So I want to caution people around that notion that VCs can help you with services that will make you successful. You need to build those yourself.
I think to chime in on that, the idea of hiring, it is now the #1 thought in my mind when I'm talking to companies, whether or not they can hire good people and manage a good team. From all the experience that I've seen working with companies, it's the single most common fault I see with companies that are failing, is they're failing because they haven't been able to hire the right people and put them in the right positions in the company. Everything else pales in comparison to that single challenge. And I've seen CEOs with terrific degrees, pedigrees, backgrounds, run many, many different companies, struggle mightily to fill relatively basic positions in a startup team of 20, 30, 40 people, let alone jumping from 500 to 1,000. And imagine, literally just imagine how many interviews had to be conducted to get 500 more people into a company, and how much training and budget and time and energy went into trying to integrate 500 people into an organization. It is a huge lift. I cannot express how challenging that is for a company.
I'll add one thing to that, which is one thing I always looked for in a company was, a founding team. A founder is not the same as a founding team. You need to see a founder, in my opinion, who has been able to attract, before your capital comes in, the best and the brightest, away from a great place, away from a great company, because it gets, to your point of they can attract great talent. I'm a huge believer that, the best teams are, it's a Batman and Robin, it's a, Clark Kent and Lois Lane, it's, it's a Mr. Outside and a Mrs. Inside, or vice versa. It's people who have complementary skill sets and work well together. And we want to see that before the first dollar goes in, because that's a huge risk if you've got a lone wolf out there, who can never delegate or hire someone good.
Okay, I want to shift gears for a second and talk about the public markets, because over the last year plus, it's been pretty choppy out there. And I know in several of your businesses, it's actually had some sort of knock-on effect or spill-on effect, sometimes to the positive, but often not recently. Can you talk a little bit about, you've all got tons of experience in early stage VC. How much do the public markets affect the mindset of the early stage VC investor? How conscious are they of what's actually happening out there? And to what extent should they be? Micah?
Well, I'll jump in because cannabis has seen probably the largest run-up other than blockchain in the public markets. It's been a huge challenge for VCs, particularly we're based in the US, and the Canadians have a very different approach to startup financing. They actually list their companies very, very early on public exchanges, whether that's the Toronto Ventures Exchange, TSXV, or the Canadian Securities Exchange out of Calgary. What that has done is create a lot of problems for us in the US venture community because the valuations coming off the public markets are just stupid. And it's all dumb money coming in to these companies, driving up valuations to ridiculous multiples. I mean, we're seeing over 100x revenues, if companies even have revenues. These valuations have no basis, and to go back to the point about trying to reverse engineer a valuation, you can't get anything close. The value of these companies is larger than the market they're looking to serve, which makes absolutely no financial sense. So it's been a huge challenge for us to get entrepreneurs to come back to earth and say, okay, you're going to be really uncomfortable if you raise money at, let's say, a $100 million valuation when your company should have been valued at $10 million. The problem is the next round of financing, when you need it, is going to come in at $20 million in value or something. Because the new VC is going to say, okay, I'll come in at 20 because that's a reasonable number, and I know a year ago you raised it 100, but that was completely irrational. Well, that means you have a really upset shareholder base behind that initial financing. And so we're seeing that now come to fruition. It's been a huge problem for us in the cannabis industry.
Jacques, you guys have taken plenty of things public recently. How do you think about that?
Yeah, no, I think, you know, you having it as a positive thing, at least for some time until it became stupid, as you said. But people that were around in 2001, forget 2008, there was a blip for people that are in our business. But in 2001, the world stops when the capital markets freeze. And you could say, well, you know, the companies are very early stage and that's the end stage and who cares? It doesn't work like that. You shut off that pipe and it ripples really, really fast all the way to the startups. So you can't get out, or the value of getting out, instead of being a 10x revenue, is now a 3x revenue. Everybody does the ripple effect, and now you can't even get your next round up. And you know, there's very famous articles that keep coming out because people feel it's coming again, that you have to always be ready to be fully financed if the recession hits or if the stock market crashes. And that's a very sage advice, because the day it happens, if you're not fully financed, you die. And, you know, as somebody famous said, again, I'm quoting people I don't remember, you know, and they said, you know, how did you go bankrupt? And the answer was, at the beginning slowly, and at the end very fast. And that's really the danger here, right, is the markets end, and then you're facing with a wall, and it's not a good position to be. So the capital markets, even though shouldn't influence us, they influence our companies, and as a result of that.
But that's a every 10, 15, 20-year phenomenon. I mean, 2001 is a long time ago today, but there's plenty that's been happening in the capital markets in the last 5, 10 years that is still bouncing around and you know, causing heartache at different times. How much does that play into the mindset?
I think the main thing that affects us is public multiple comparisons. If the companies that we invest in are in sectors where they're trading at 10x, you know, last 12 months revenue, that's kind of an indicator of how we're going to value them. If they're trading at 2x multiple, then that affects us too. If you take a good example, and Israel suffered from it more than others, look at the ad tech space. You know, a bunch of companies went public and they all crashed. It was impossible to finance a perfectly good ad tech company for the last 3 years. Why? Because there's this perception that, you know, there's constipation at the end, therefore you can't do it at the beginning.
Interesting.
Yeah, I would add to that and say that, you know, I believe that at the end of the day, public markets are going to trade at some multiple of earnings, and earnings matter. And we'll have discontinuities, whether, you know, oil price goes up or down, it can be good or bad. Inflation's up or down, it's good or bad. And those are what I'm going to call discontinuities. We had a discontinuity in December, you know, in the U.S. markets where people were worried about, you know, China or Trump this or Trump that. And, you know, we're back to sort of, you know, earnings are still strong. I think the important thing to me, and what that means for private companies, is at the end of the day, we want to be able to see private companies have a value as a public company that ultimately is someday going to be based on earnings, and that is rational, not irrational. You can't be a $20 million company and realistically, in my opinion, have a $2 billion valuation and expect to sustain that for some period of time. You know, something bad's going to happen. You're going to have a recap round, you know, or, you know, when capital becomes scarce, you're not going to be able to raise it. And so, you know, to me, I think the ripple effect is the importance of thinking about, you know, what's the ultimate value of your company if it were a public company at some point and some point in time. And if I could make a trade today out there in the public markets, but in the private markets based on the public markets, I think the point of overvaluation today begins with a B. Because so many companies want to have a $1 billion valuation, they do obscene things to the rest of the capital structure of their company, you know, to do that. And so I think if I could make a trade today, I would short the 250 to 300 companies that have a $1 billion value and buy the next 1,000 or 2, because I think there's an excess valuation for those over $1 billion that is not captured for the aspiring next group.
Amazing.
So.
It's a slightly different perspective from what was said, so as not to repeat them. Looking at the beginning of the funnel, as a seed stage investor, one of the benchmark that we use when investing or deciding to invest in a company is whether this company can go public on a major market, NASDAQ, for example. To go public on NASDAQ, you need certain parameters. You need to have certain health parameters, as I call it, growth, percentages, margins, customer base, visibility, et cetera, to be a public company. So that's something that we look at as we're evaluating this company's potential to be that billion-dollar company, or as we were speaking earlier. So that's the first point. The second point is that the most successful funds, or the vintages of the most successful funds, have been during recessions, right? So they've been raised and started to invest during the downturn, and that's because the prices have been the most attractive, because there's lack of capital in the market, because everything freezes. So when you find those good companies at that time, those are the most profitable or highest potential.
Okay, great. So I'm going to ask one more question. If we have time at the end, we will be able to open it up to the crowd for 2 or 3 questions as well. But the last one I want to leave on today is the theme of the summit this year is startups creating a global impact. Right? And we're talking a lot about impact investing and all the associated sort of positive societal benefits that come from that. My question to the panel is, as investors, what responsibility do we have to be thinking about greater good, socially, environmentally, in our investment decisions? Where does that line begin, and where for you guys does it end?
Well, I'm in an impact environment, being in the cannabis industry. Maybe some of you think it's good or bad. I'm not sure sometimes. But we have environmental impact, we have criminal justice impact, we have medical and healthcare impacts, which are very, very significant. I think it is important for an investor to pay attention to those impacts and not ignore all of those sort of external factors that are beyond the core of the business. However, at the end of the day, we are finance people, and I think it's our responsibility to sort of make that money where we can. You've got to have a moral compass, and you've got to have an ethical compass about how you're going to run your business. But I don't necessarily have a negative judgment per se against folks who, for example, invest into, I don't know, a vice industry like a tobacco or recreational cannabis in our particular industry versus going into medical cannabis as a different type of investment. I think that's just a choice that you make, and as long as you're clear with your limited partners and you're clear with yourself and your team, I think that's a reasonable position to be in. Rather than trying to sort of say everybody needs to be doing the exact same thing.
Yeah, I think we've seen a significant shift in the last decade with social responsibility, environmental responsibility being real things. Massive amounts of money being put by corporations into those things, whether it was from a financial motivation or real image motivation or just because they're good. It doesn't matter. At the end, the outcome is the outcome. And I think you have a whole generation of entrepreneurs and workers that care about doing the right thing.
And consumers. And consumers as well, right? And
consumers as well. And so I think beyond the responsibility that some of us feel we have as individuals, I think from a business standpoint, I think it's foolish today to put money in a company that whenever you think about what they're actually doing, it makes you wince. Because if it makes you wince, it's going to be very hard to attract capital. It's going to be very hard to attract talent. And so you got to think about that. And for an example of that, the wave of privacy that has started about 18 months ago actually started with Snowden, effectively, but really started an avalanche with the whole Facebook revelations and so on. I think that's going to continue, and I think a whole series of companies are going to get wiped out because they didn't pay enough attention to that.
Just an aside on that, in 2005, I talked with Google about global threats and sort of what was most important to them. And I'm a cybersecurity expert by background. That was my training. And my one comment to them was privacy and data security was going to be an existential threat to their company if they weren't paying attention to it and building it in. They laughed me out of the room and said they had no interest in talking about privacy because they didn't consider it very important. Next thing we know, we saw the EU step in and hammer them with a multi-billion-dollar fine.
I would just add back on the point about investing in a socially responsible way. The entrepreneurs these days are making it easy for us. They're coming up with great ideas that are easy to back, and we're investors in Beyond Meat. We have a couple thousand of them here, so make sure to go try the burger out there. And they're saving water on the planet. They're having us eat less actual meat. We're investors in Zipline that's saving lives in Rwanda with drones. Prolacta that is saving premature babies. These are not things we went out looking for. These are things that came to us from entrepreneurs. So I think, even though we're not an ESG fund, I think we all have lots of ESG investments today that we wouldn't have had 20 years ago because the entrepreneurs are bringing them to us.
Amazing. Anything on that? Okay, great. So we have about a minute and a half left. So if anyone has a quick question, or maybe we can even sneak in two, sure. Are there microphones at the back that we can hand people, or? Cool. Well, just for you, for sure.
This question is for Micah. You said something important to helping companies grow is hiring good people. And what on the value-added side of a venture capital investment does the VC firm provide in terms of helping entrepreneurs hire good people?
Yeah, so hiring people is super hard. VCs are, I think, actually it's one of our strengths is hiring good people, or not hiring them, but actually referring good people to you. One of the huge wins that VCs can bring to the table is the fact that we actually have all these failed companies in our portfolios that often have really good people in those companies. And so we have a bench, a depth to refer people on. Because just because a company fails, like I said, there's so much luck involved in company success or failure. There are plenty of great companies with great people who end up failing for one reason or another. And those people often can migrate to another company that happens to be luckier and doing a bit better. So I think that's one of the big strengths we bring to the table.
Okay, last one. Any other questions? Nothing out there? Fantastic. That'll be. Oh, hand up. Go for it.
Hi. Here in the VC arena here in Israel, there's this famous known phenomena that at late stage or even scale, it's being dominated by American VCs. They actually force Israeli entrepreneurs to move their headquarters to the States and keep their R&D here in Israel. I think this is the notion we have. Is this going to stay forever? Is there a way for like older entrepreneurs who have families who want to stay here?
Jack, I'm going to let you take that one and then wrap up.
First of all, to the notion that there's no late stage capital in Israel.
Would you just cut everything for that answer? Wow. It's time up. Okay. I guess we'll answer that offline afterwards. Guys, thank you very much. Appreciate it.